This is kind of one of my main arguments for this proposal. I don't think being fine is necessarily a winning attitude. Like, the whole point of acceleration is this: stress the system, make it better in the way that we think it will get better. If it doesn't, we learned and we will adjust. But if you do nothing, then we're kind of just waiting, and like, this passive game, in my view, does not work.
Digital Asset Summit in New York is right around the corner. Some of the biggest names in crypto and several major institutions are going to be there. There's a lot of noise in crypto right now, and I think this conference will be pretty high signal. We're doing a live Lightspeed taping with Solana's co-founder Anatoly and Kyle from early Solana investor Multicoin Capital, so you won't want to miss that either. I hope to see you all there, and you can use the code Lightspeed10 for 10% off tickets at checkout. Hello and welcome back to another episode of Lightspeed. I'm Jack Kubinek, hosting alongside Mert Mumtaz. Today we have a Roundup episode, and we have Dan Smith from Blockworks Research. Dan, thanks for coming back on the pod.
Always a pleasure, my friends.
The place we want to start today is a lot of the online Solana chatter. SIMD 228, the pending change in the Solana staking mechanism. I feel like when it was first announced, it wasn't super controversial, but as a vote nears and as everyone has had more time to think about it, and frankly, as the price of SOL has gone down a good bit, there seems to be a lot more opposition. It's been a pretty spicy debate online. Dan and Mert are deep in the data and the validator world. So really, I just want to kick it over to you guys as you've watched this debate unfold. So Mert, I'll start with you. What is SIMD 228 and where do you stand on it?
Sure. So first, let's describe what it is. So SIMD 228 is basically a proposal originally by Multicoin, but Max Resnick, who's been on the show before, took it over. Lead economist at Anza, which is basically Solana Labs. So that's the pretext. So the proposal says actually more pretext is needed, because you need to first understand how inflation works on Solana. And the way it works on Solana today is it was hard-coded in as an inflationary curve that decreases over time. And it was copied directly from Cosmos 4 or 5 years ago. And actually, Anatoly himself told us this on the show, so that's how we know as well. And this proposal says, well, that's kind of weird. It's arbitrary and time-based and doesn't take feedback from the market or any network conditions into effect. So let's make it receptive to feedback. Let's make it market-based or network-based, however you want to call it. And so what it says is that, okay, let's target a staking rate on the network, right? So like, how much of SOL is actually staked on the network? For example, if it's 90%, let's decrease the staking APY to disincentivize staking such that it becomes lower until our target rate, which our target rate currently is 50%. So 50% of SOL should be staked. So it says we're overpaying for security right now, so we should just not do that. And then, but also, so one of the things that people get wrong about the proposal is it's not about reducing inflation just on its own. It's about making it dynamic to network conditions. So for example, if the staking rate falls to 30%, then the staking APY would actually go up over time, over 10 epochs, which is like roughly 3 weeks, until we get to the 50% staking rate again, right? So it's about basically making the staking rate and the staking APY somewhat based on market conditions, as opposed to just purely time-based, which it is today, right? Like, no matter what happens to Solana today on the network, revenue could 5,000x, it could be under attack, like whatever, anything, the inflation stays the same. And so this says make it market-based. So that's my summary of the proposal. Now, there's people for it and against it, obviously. And this is probably the most divided one I've seen, although it's unclear if we'll see how the voting goes. So the voting goes live by the time this episode airs, or maybe the day after. So the people for it obviously they think excessive inflation is a cost, and also it's very inefficient and leaky. So for example, a lot of that, so like if you think of inflation as like this transfer, then there's actually a lot of people in the middle of that transfer, like custodial exchanges or just exchanges and all sorts of other people who take a cut of that. And so if you do the math, that ends up being hundreds of millions of dollars per year that is being paid out from the network for really no reason other than the system is inefficient. And then, obviously there's other things to be said about, token fundamentals and the maturity of the network and a better economic policy and all this. There's some other arguments made such that, like, well, if staking rates give you 8%, 9%, then why would you even use DeFi, right? Because how is DeFi going to compete with that? I don't personally buy that one too much, but it is one of the arguments made. And then the people against it, so I'm going to hold a spaces tomorrow on Tuesday at least, where people kind of voice this out on both ends. But the people against it basically say something like, well, there's a few different angles. There's the institutional angle, which is that, well, if it's 8%-ish APY, that's pretty attractive for institutions for like a staking ETF and all this, which I personally think is a crazy argument because it's just purely a focus on nominal rates and ignores real rates. And like, if they wanted to do that, they could just hold Atom, which pays 18%. But I don't see anyone or too many people buying that anyways. And then there's like some cases in which if issuance drops a ton, but also there's a big bear market and MEV rewards and REV in general goes down and the price goes down, well, then some smaller validators might be running at a loss. And so, but like that requires a very extreme theoretical case to happen. And it also ignores that Foundation has said that if that were to happen, like that's what the program is there for in terms of delegation, right? Like voting costs and all this. So I think it's largely theoretical and not going to happen. There's some other things about like, okay, but how do we know what the right number is to set? Like, why should it be 50% staking rates? And why should it be gradually adjusted over 10 epochs? Why not 100 epochs? And so all sorts of things like this. I personally think those miss the point. Like, you're never going to, in a complex system, derive perfect initial conditions. That's just never going to happen. The only thing you can really do, in my view, is set the system to take in feedback properly from reality and then adjust those or intervene if necessary after, right? You can adjust them. But I don't think making it arbitrary because it's always worked this way is necessarily a productive mentality. So that's my take on it.
Now for a quick word from today's sponsor.
This episode is brought to you by Bonk Bets, the fully permissionless sportsbook built on Solana. Bet with Bonk, Solana, or USDC and get automatic payouts for winners. Every bet that you take earns Bonk Bets points towards cashback, discounts on losses, and more. Lightspeed listeners get 10% back on losses to bet again. Just visit bonkbets.io/Lightspeed or click the link in the show notes. Just a quick disclaimer that exclusions apply and Bonk Bets is not available in all jurisdictions. Thanks to Bonk Bets for making today's episode possible.
Yeah, I think there's also an element of like, what's the adage? Like, don't let perfect be the enemy of good. I think a lot of people agree this is directionally right. And, you can squint at it and be like, I like 90% of it, but this 10% piece, like, I would do it differently. And it's like, okay, well, I think we gotta move the needle somewhere. I'm personally for it as well. I think the biggest you brought up a good point. Like, there's a lot of reasons why various people aren't for it. I think a lot of them are pretty noisy, to be honest. Like, the DeFi hurdle rate thing, I think is interesting, but it's like, I don't know if that's a reason that I'm like super for it, right? We're going to bring down the hurdle rate and we'll get more DeFi activity. Like, maybe. I think there's a pretty good argument for that to be had, but it's not just one-to-one there for me. Whereas it's, when you look at the data and you see 90+% of inflation going towards stakers. So that's like, it treats 100% commission validators as stakers because they're using their stake to be in that position. Like 90% of inflation goes to stakers, 10% goes to validators, right? And when I see that, I'm like, okay, that is an obvious sign of overissuance to me. Like, that is how I personally am determining, are we overpaying for security in this context? Issuance in this regard is just a tax on the unstaked position, and I struggle to see why that makes sense. I think you can have a position that's unstaked SOL is not doing anything beneficial to the network, so like, you shouldn't be rewarded. That's great. I don't think you should be rewarded, but that doesn't mean you should be penalized. I think there's utility around having the unstaked token as well. And I guess like the pushback I would have on this is the only way you can earn your share of rev as a token holder, or your share of REV, or your share of the economic activity that happens on the chain, is by staking your assets. So I'm also like, my base case is if this went live tomorrow and issuance was cut immediately, I struggle to see a huge outflow of stake. I really, really do. I do not think people are staking a 70, 80, 90, 100 vol asset for the marginal 3 to 6% of yield. I really, really struggle to see that. I hold this true across like every crypto asset, right? Like I think in Ethereum land, everybody's like really pushing the staking ETF as a huge catalyst for like ETH price action. Makes no sense to me. All right, I don't think anybody's holding out on buying ETH ETFs because they're going to get 3% on them now, which is the same function of how I feel about people unstaking, right? I don't think you're going to get an exodus from staking. I think if anything, you'll see people rotate from like native staked into LSTs and then try to use those LSTs in DeFi, which I think that's net good. But that's not like 1-to-1 there for me. So yeah, I guess like to summarize here, my position is there's evidence that there is overissuance of staking. Even looking at just the nominal amount issued between Ethereum and between Solana, I think suggests that Solana is overpaying. There's about a 2x gap between the two, with Solana being higher. And then two, again, if 90% of issuance is going to stakers rather than validators, to me that suggests that you're unnecessarily taxing the unstaked position. Now, where I think it's really beneficial is for helping validators get to a break-even split. So there's a couple great calculators out there, but if you pull any of them up, you're going to see that it costs roughly 10 to 12 grand a year to run the hardware for a Solana validator, and it costs 50 grand a year to participate in votes. Votes are actually on chain; they're transactions that interact with the specific program. Because of that, there's like a real fee attached to it. And so that is the burden of running a Solana validator today, is paying about 50 grand a year to participate in consensus. And so the fear is if you drop issuance too low, then validators that rely on taking a commission out of that issuance will now be unprofitable. And that is like a reasonable concern to me, but there's also like the balance here of, okay, but if the only reason you are profitable in the current world, that means that token holders are subsidizing the existence of this, that specific validator. Which, like, should that happen? Should that not happen? I think that's like more of this philosophical debate of like, how many validators is the right number to have in the set, and how do you measure decentralization? Well, I really don't think it's true like number of validators. I think that's like a rough estimate in a quick and dirty way. But if you really wanted to get into it, it's more like geographical distribution, jurisdictional distribution, and then like across different data centers or ASNs. And so to me, that's where like the Solana Foundation delegation program can play a more interesting role, sort of like Mert's backstop point. I think they can also have a very targeted approach of like, once you have a better understanding of where the validator set is in the world, you can target specific locations and regionalities. And I know they tried to do in the past, and it's just not like you can't just like flip a switch and make that happen. But that could be an interesting way to get to a improved decentralization, improve on the spectrum, rather than just saying, oh, we need a billion different nodes, right? Like that's probably not the end goal. And it's a bit antithetical to the IBRL mentality as well, right? Like there is a cost to the marginal node.
Yeah, there's a lot there. I think, as you said, Dan, the key question is Solana overpaying for security in terms of the network's emissions? I also think that one other thing to note is just that like, it is probably true that you want people to unstake their SOL. Like I think around 63% of Solana is currently staked. And assuming like 10% of the network is in liquid staking tokens, that staked Solana doesn't do anything. So it's like, if you have a country and 63% of wealth is in savings accounts where people never touch it, that's not a great state of affairs. You want people to be buying stocks and supporting businesses and like doing productive things with the asset. Now, that being said, I don't know if I necessarily buy the argument that lowering the staking yield increases DeFi activity, because like there's, I don't know, people who never look at their Solana staking yield. There's a lot of people who stake Solana through Coinbase who aren't going to go start like doing, yield farming strategies on some DeFi platform tomorrow. So it seems a little simplistic to make that argument, but I do think that, as you both said, directionally, like it's maybe better for people to unstake Sol. I guess like
I want to jump in real quick, Jack. You brought up an interesting point there about Coinbase. Like Coinbase, Binance, Bybit, any of the large exchanges that offer a staking program, right? Like they milk a pretty good amount of. I don't have the figures in front of me, but they run pretty high commissions, relatively speaking, and that's just like they're providing a useful service to their users. I'm not arguing that at all, but they're not going to turn that service off if this the issuance gets lowered either. So
yes.
I think it's also interesting to note that the revenue impact actually hits both ends of the spectrum, right? Like the 0% commission validators probably don't have like a huge care over this particular situation in terms of like their actual bottom line. Of course, they care obviously about the network health, but I think like the Coinbases and the high commission validators also care just as much as the low commission validators as well, for different reasons, which is interesting.
Mm-hmm. And I guess one other piece that we should mention is I think Max Resnick talked about this on Twitter, but like in a world with no friction, it's not necessarily, or like the inflation rate doesn't necessarily matter. But when you're moving value around in Solana, there's these little points of friction that take value out of the ecosystem, and one of those is tax. So the IRS, I believe, generally views staking rewards as income, which means that it's not like capital gains where you pay a percentage of the amount of money you made. You have to like pay taxes on your staking rewards as if it was your paycheck or any other kind of income, which to me is a little bit of a weird way to look at staking rewards, but that's neither here nor there. And the US has the largest capital markets in the world. Like the tax implications in the US probably do end up mattering. So that's one other consideration as well. Have we hit all the major points?
Yeah, the tax one, I guess I'll touch on too. Like this is like this left curve way of doing this analysis, but price equals supply, value divided by supply, right? Price equals value divided by supply. When you issue new tokens via inflation, the value is unchanged, but you are increasing the supply, increasing the denominator, and therefore like price goes down. So that gets felt when you have to, sell a portion to cover taxes. But the reality is like that is how the models will run, right? I think, most people probably listening to this podcast will be of the opinion that L1s are valued as a function of their rev or will be into the future. And in that case, again, that's how you determine your value. And then your numerator and your denominator, again, increases with inflation. So you can shield yourself from some of that inflation or that supply growth by staking. But if you look at the unstaked position here, you're basically treating it as almost like a second-class citizen, which may or may not be a bad thing, but it's worth acknowledging. And I do think that when you do not, I guess like zooming out a bit, inflation was a great way to bootstrap the network. And now you fast forward to today and there's a very successful and active network. So you'd have to ask yourself, at what point do you remove the bootstrapping phase? I think they're like some of the Overclock team has been pretty vocal about, the smaller validator side. And I respect their opinions a ton, and it kind of like forced me to take a double look there. And I think it's reasonable to say, I think their biggest concern is, if we're heading into a worse market conditions, bear market conditions, and REV drops a significant factor here, then, you're not only hurting the small tail of validators, that every step function lower that we go, you're actually hurting a larger percentage of validators, which is true and worth acknowledging. So I think like that's probably the one point where I'd like to see the community like rally around a specific answer. Is like, how large do we want the validator set to be? And then when REV changes, how does that impact that specific group of validators?
Another point, Dan, I've been thinking about sort of related is like, if SIMD 228 doesn't pass, like, is this the last chance almost to change inflation? Because you look at ETFs, you look at news about a strategic crypto reserve that involves Sol, like the network is only going to get larger and more complex and have more stakeholders with entrenched interests. And making any big change like this, I think by rule, the people who see downside from the change are going to argue against it more strongly than people who might benefit from the new world, if that makes sense. Because you can see right now, hey, I'm a validator and I'm about to be unprofitable. I'm going to lobby against this. But if we're making arguments about like theoretically sell pressure decreasing in the future because people don't have to cover their tax liability, I think that inspires less, hardcore arguments from people who might benefit from this, SIMD. So I do wonder, like, is this the last chance to meaningfully change Solana inflation? I mean, we do know, like, in about 10 years, it'll go to around zero, like, just because of the current emissions curve. And so it's not like emissions won't go down over time. But I do wonder if this is an inflection point of, like, if you don't get this passed now before we have ETFs. Sorry?
It's not. I don't think it is. I think people are like super doomsday analyzing this, especially on Discord. I mean, like, my God, some of the things I've seen are like, well, inflation is what brought developers to Solana. Like, just completely crazy, irrational, emotional arguments. And I think that really hurts. I mean, not only their point of view, but just the entire process. Like, especially this thing about, like, I've seen a lot of this, which absolutely needs to stop, which is like, oh, well, this author might have some motivation. And it's like, I mean, did you try looking at the proposal on its own merits and actually, form a rational basis for anything? Because anybody can make up any sort of conspiracy theory on a person's motives. That's just not gonna, like, for example, people are saying like Helios benefits from this or something. That's actually not the case at all. I can guarantee you we will lose by far the most amount of stake from this, by far. And like, I'll put any sort of money on that. And so then why are we voting for it, right? Like, I think people really like have this weird cynical view because it's like multi-coin or something, which, by the way, have shown kind of repeatedly over time that they're extremely long-term oriented and have helped Solana more than most people care to understand. But anyways, my point with that is, one, I think the doomsday stuff is like overdone. Let's say this passes and then the parameters are like leading to weird results. We adjust the parameters, right? If it doesn't pass, well, there'll be more chances to do another proposal to change the curve and whatnot. Now, I think there'll be higher risk at that point because the network arguably will be bigger. So that's kind of reason to do it now. But like, either way, we're going to be fine. But, and this is kind of one of my main arguments for this proposal, I don't think being fine is necessarily a winning attitude. I would rather, like, the whole point of acceleration is this: stress the system, make it better in the way that we think it will get better. If it doesn't, we learned and we will adjust. But if you do nothing, then we're kind of just waiting. And like, this passive game, in my view, does not work.
Yeah, complacency kills. That was like the message of the 2025 for like all of the Blockworks team on the research side internally that I kind of like wanted us to rally around. It's the wrong mindset, right? You get like one moment of being in the lead and you're like, oh, we're the best thing since sliced bread, and you just like stop doing things well. I'm a Bama grad, so I study the philosophy of Nicholas Saban, and this is like beaten into my head from watching hype videos for Bama football every year.
Roll
right?
Tide.
Like this is amen. This is like it's just the mentality of like, you win one national championship and you're like, oh, next year is going to be a breeze. We're going to just walk in and do the same thing. But then everybody lining up against you the next week of the next game, their mentality is, we're playing the number one team, so we have to bring out our best, right? And like, that's what happens, right? Think about 2 years ago when Solana was like, oh, Ethereum's crushing it, and we want to like line up against Ethereum and like be the best L1 blockchain for builders, right? And like, you fast forward to today, and by many metrics, that's very true. But the second you start like, taking the next day off because yesterday went well, it starts to unwind. And it's like just how humans are programmed, and it's very hard to fight against that. But totally agree with that mentality, Mert. Like, God, it's frustrating to see that anywhere. But it's very easy to do that, especially when you're arguing about like what some people might view as a welfare check, right? Like, if you're a token holder and you know that like there's some validators voting no because they are like will become unprofitable because of this issuance, then like that's probably a little bit frustrating to you, right? Like why am I just paying for your existence if you're the 197th validator on AWS US East? Like you're not adding what are you doing for decentralization here, right? And like I think that's a reasonable argument to be discussing. So super pumped for your spaces tomorrow, Mert, because it sounds like it'll have a good back and forth. You've got people on both sides of the aisle too. Like unfortunately, you and I are both for it, so we can't have like a super rigid debate right now. But yeah, super excited for this Twitter Spaces.
Well, let me throw out this question, which is something we've alluded to, is that were SIMD 228 to pass today, and especially if the price of Sol falls further, some validators become unprofitable. Like some number, I don't know if it's dozens, I don't know if it's hundreds, it depends on how you model that. But you'll see people like stop being Solana validators, presumably. And that's been one of the criticisms, is you're quote unquote like lowering the decentralization or limiting the decentralization of Solana. I think the response to Charmaid on Twitter is, well, the number of validators doesn't matter. The Nakamoto coefficient matters, i.e. like how many people it would take to collude and attack Solana. So I guess I'll throw this to you, Mert. Like, is it a knock against decentralization if, say, 200 small Solana validators are unprofitable and unplug their rigs?
There's a few things wrong with that argument on both sides. One is that, first of all, the tail end of validators who are smaller generally charge no commission on issuance, which means that a reduction in issuance is not going to do anything to them. Now, it might make their stakers unstake, assuming stakers are like this efficient, which I know for a fact they're not, being the largest validator on Solana. Now, you project that outwards, and then you can make the argument that, okay, well, like, maybe 50 to 250 validators start going out of, or start running at a loss. And okay, now this has hurt decentralization. Okay, well, for it to hurt decentralization, those people would actually have to be drivers, not passengers, right? If they simply have a node spun up with a Docker config that they've deployed, or whatever Ansible config, and then they just collect checks every epoch, and then follow whatever Trent does on Discord with no actual opinions, that does not change decentralization in any way. In fact, it makes it better because now you have less sense of security. That's just pure theater. Well, another one of these actually is the Nakamoto coefficient, which for some reason people keep saying is like 19. It is not 19. It is less than half that, because the amount of validators who run unlabeled validators who are still the same entity, right? So there's a lot of, and this is what I mean, going way back to my earlier point around feedback from reality for systems. In systems that don't have this feedback, there's so many hidden risks that they become so fragile that they will collapse. There's like so many examples of, like 2008, for example. There's the amount of examples for this is actually mind-boggling, and so. And then, by the way, probably the strongest case is part of this argument is that if that were to happen, Solana Foundation has already said, well, if that case were to happen, this is what the program is for, right? So they would help them. That is why they have money. And then Anza is also in parallel working on a vote cost, because that's the main cost for a validator that's small, at least. The vote costs to be different. Maybe, their idea is to reduce that cost. And then perhaps some of those smaller validators will have better margins. And so I don't think, and I've already said this publicly. Yeah, go ahead.
Can you expand on that, Mert? Like, why are vote costs a problem for small validators, and what could potentially be done about that?
Well, so as a validator on a proof of stake, or at least Solana, you have to vote on the right fork that you think is the correct fork for the blockchain. And those are transactions. And so transactions have costs. And when you do the math, it ends up being like 2.1 Sol per epoch, or maybe like roughly 365, like 1 Sol a day or something like that. That's your cost. And obviously, the smaller you are in absolute size, the more of a cost that is for you, right? Versus like if you're making, $20 million a year, 365 Sol is not going to be much for you. But if you're making 366 Sol, right, something like this, that's a huge thing for you. And so that's how it works. And so, but perhaps and now it's being looked at, perhaps it's inefficient. Perhaps the vote transaction could be smaller, and require less cost. Perhaps there's other schemes. And then even on the non-technical side, perhaps the foundation, instead of just delegating stake to you, maybe just helps you cover the vote costs, which is actually already how the foundation delegation program works to an extent. Like they do cover vote costs for the first N months or something. Yeah. And so that's what we mean by that. And so like, I think, and by the way, all of these analyses completely forgo that these validators are businesses. Like, okay, imagine Helios. If you make $0 because Solana developers all left for like 2 months, we're not just going to go out of business. Like ideally, we are not completely challenged and have some sort of balance sheet here, right? And some cash. Like if you're running a thing at 0 run rate, just on the edge, like that is not going to get you to not die in any business on earth. Like there is no business that works like this anywhere. Now you can go to Canada and get a welfare check and all this, but like that cannot happen in business. So I really don't think, I think there's merit against SIMD 228 not passing. There's some good arguments, but the reduction in decentralization, I don't think will happen. I'm actually quite sure of this.
Yeah, I think that's, again, my point earlier about like kind of like rallying around the idea of like what is the objective we're trying to do specifically as it pertains to decentralization. If you look at Ethereum, you have something like 10,000 nodes on the network, and that's their MO. They on the spectrum of decentralization, their goal has been to max out on the decentralization side. And then you look at one of the, like Gen 3 newer chains like Aptos or Sui, right around like 100 something nodes. And that's like pretty intentional and no plans to scale in the near term. I think they're going to gradually build that out. But to me, that's like sort of the two ends of the spectrum. I guess that's not true, right? You can even go further to the left of that. And there's something like Hyperliquid with like 16 validators and like 4 that control the bridge contracts. So it's like, where do you want to lie on that spectrum? I think Solana is, somewhere in between the Suis and the Aptos and the Ethereums. I don't think it's trying to like be the max decentralization end of the spectrum. I think it's probably worthwhile to be like, let's say, an order of a magnitude above the Suis and the Aptos. So somewhere around the 1,000 benchmark probably makes sense in terms of node count. But again, like where those nodes are and who is operating them is extremely important in terms of this conversation. And I do think that's where it could be really interesting for the Solana Foundation. I don't know what their views on that are and like how realistic it is for them to play a meaningful role in that capacity. I think it's like pretty hard to know who's on the end of. I mean, I don't know what they're like, if there's a KYC process to be part of the delegation program or anything like that, but okay. So, I mean, that makes sense, right? So if there is this KYC process, you do know who's on the other end and you can like presumably trust where they're operating this thing.
No, it also gets gamed quite a bit.
And that's because you're handing out free money, right? Essentially,
yes,
not directly, but like there is a game to be played. So it will be played.
Yeah. And like those in the past have been used to sandwich. There's been like fake IDs. And so like the amount of rent seeking that happens as a result of those things is just, I really don't think they're worth. I think like people say, oh, it's been fine so far. But my argument is actually, I think Solana would not be below XRP if they had been fine so far, right? Like there's many different ways you can spin that.
Yeah. Okay. That's actually pretty interesting too. So I don't know. It's like, again, going back to the bootstrapping thing, like the inflation should be there to ensure the network doesn't blow up. And I think that's kind of why I like this curve a lot, is it puts a backstop that doesn't currently exist. If people just all of a sudden start unstaking and there's no validators left on the network, the issuance will increase to incentivize increased participation. Precipitation. It's going to rain validators and stakers. And I think that's interesting. It doesn't really exist today. So it seems like an interesting modification. And then one other point of feedback that I saw on this proposal was basically the idea that like making the issuance a little bit more dynamic will deter like sort of that like professional investor community, which I don't have any good empirical evidence of this, to be honest. But so this is mostly just my opinion on the matter. But like when I look at Ethereum today, I've never been like, oh, such an unattractive asset because the issuance is volatile between 1.5% and -1% based on how much demand is burning ETH, right? Like I don't know. It doesn't freak me out relative to something like Bitcoin's curve, which every year what the percentage is going to be. It's gradually declining. It's predetermined. Yada yada. To me, like those are roughly the same things. Bitcoin is 0.7% of issuance this year versus Ethereum's like 1.2. I just I don't think that moves the needle. And if you look at like equities or commodities, like issuance is traditionally unstructured. I think Bitcoin's really the outlier asset here. Even something like gold, like depending on demand is how much gold they pull out of the ground every year. Like diamonds, like De Beers basically controls how many diamonds get made every year. So I don't think it's super atypical to see supply side being like a little bit of an uncertainty, or even oil, right? Like that's very controlled by a small group of countries that determine how much oil gets pulled out every year. And the price of oil is the very key input there. So that's like basically what they're optimizing for. So I don't know. I'm not super convinced that the dynamic nature of this curve makes it worse.
Now for a quick word from today's sponsor. Today's episode is brought to you by Crypto Tax Calculator. Accurate crypto taxes, no guesswork. Get accurate CPA-endorsed tax reports with full support for IRS rules. With more than 3,000 integrations, Crypto Tax Calculator supports all of your wallets, exchanges, and on-chain activity. And you can import directly to TurboTax or H&R Block, or share securely with your accountant. You can use our exclusive discount code BW2025 to enjoy 30% off all paid Crypto Tax Calculator plans. That's BW2025 for 30% off.
This episode is brought to you by Bonk Bets, the fully permissionless sportsbook built on Solana. Bet with Bonk, Solana, or USDC and get automatic payouts for winners. Every bet that you take earns Bonk Bets points towards cashback, discounts on losses, and more. Lightspeed listeners get 10% back on losses to bet again. Just visit bonkbets.io/Lightspeed or click the link in the show notes. Just a quick disclaimer that exclusions apply, and Bonk Bets is not available in all jurisdictions. Thanks to Bonk Bets for making today's episode possible.
I disagree a bit there, Dan, because I think that one of the sneaky good arguments against SIMD228 is just the sort of left curve argument that most stakers don't look at emissions as issuance, they look at it as yield. And so if you're like an unsophisticated capital allocator who doesn't know a lot about crypto, and you're like, okay, I could buy ETH or SOL. I don't know which one's going to perform better because there's good things about both of them, but I know that worst case scenario, I get like 8 to 10% return on my SOL every year, and I get like 3 to 4% on my ETH. So it's basically hedging the downside. I think that's kind of a powerful, if a little bit wrong, argument that is an underrated reason why SIMD228 might not be great for like increasing just people's interest in SOL as an asset.
It's not a little bit wrong. It's extremely wrong. I hate it. And that you're right, though. That is like a view that is held. I think that, Mert kind of got at that earlier with nominal versus real rates. But it just goes back to blockchains are pitched as like these transparency machines, and pulling data off of them is relatively straightforward, but understanding that data is extremely complex. This is just the umpteenth example of exactly that, where that is not true, but people see big number, APY, ape. It's terrible. And that's like, we've played I think I'm pretty proud of Blockworks' role in trying to improve the data and improve the industry. And this is another area where I think there's a huge opportunity to instill, like, what does staking yield actually mean? And I don't know, if I was boiling down my position on 228 into like one sentence, it's basically just pushing the network closer to leaving its beta phase. And it has a bootstrapping mechanism, inflation. And now you're transitioning off of you're kind of like pulling the welfare checks in a little bit and optimizing for REV creation, right? That is how you sustain a network into perpetuity. And it's also important that this curve doesn't go to zero as well. I don't believe. Mert, correct me if I'm wrong there, but I think it stays. It's like asymptotic to like 0.5% or something, that makes a lot more sense. I think the initial curve did hit zero, and that actually kind of does freak me out a little bit. I think there's some level of minimum viable issuance here that does make sense. So net, I think this is really just the right step forward.
Yeah, there's a calculator. I can pull it up in a bit. I don't think it goes below or even 2.0. The other thing I would say, which is totally unrelated to this, and we can probably move on after this, is, and I tweeted this the other day, which is that misinterpreting data is much worse than not having data. And I mean infinitely worse, because you get false certainty. And the problem is this happens all the time in crypto. And then you kind of get these people, you get this sort of framing of like trust the science or something like that, where it's like, well, what even is the science here? But in blockchain it's much worse because people think it's accessible, which it is. But accessible is kind of a two-factor equation. There's getting the data and there's reading the data. Reading is not so easy because you need to look at things holistically, which is why Dan is Solana's savior, because he can actually show the data in a meaningful way. That's not just like weird hype numbers that are detached from reality.
No, dude, active addresses. It's the number one metric.
Absolutely. And so I would exercise, and probably listeners are already aware of this if they listen to the show anyways, but I would exercise very strong caution to make arguments based on shaky data rather than just using reason and logic. Like, super underrated to just use logic somehow, but that's how it is.
Yeah, and it's also interesting, like infusing data into the decision-making process, I think is it's a challenge. And it's, when you look at like I don't know, like when I look at what Tolly has done, and it's obviously not just him, but I think he's got this like, you hear so many people say this, and so why I'm using him as the example of like, his intuition is so fucking good. And like, people will debate and be like, nah, dude, you're wrong about X, Y, and Z. A year goes by and you're like, was dead right.
Yeah.
So this industry as a whole has gotten very far on like this intuition-based decision-making. And it's about just like, it took a while. We don't even know what the right metrics are in a lot of cases, but I think we're gradually inching closer to a world where that's no longer the case, which is exciting to me personally.
Mert, can I ask you one more question before we move on that hasn't really been addressed, but a lot of the concerns about smaller validators and their costs tend to be allayed with this appeal to the Solana Foundation delegation program, which is like they can serve as kind of a backstop or continue to cover vote costs or whatever it is. But like, you want the delegation program to go away long term, right? Like it should be a temporary thing. And obviously the Solana Foundation can delegate its stake wherever it wants. But at the point that it's paying for vote costs, it's like incurring a cost to the foundation, which can't last forever. So is there any concern to you about like an over reliance on that program as essentially bailing out unprofitable validators?
So look, I mean, I've wanted the SFTP to go away for a long time, or at least actually, I wouldn't say that. I would say make it available only to app teams and core contributors, like people who are actually genuinely putting an effort for the network, as opposed to being just idle. Okay, so, but it already exists and it will exist. And so the thing with your argument specifically, it only kicks in during an extreme bear scenario, right? Like block rewards are down, MEV is down, the price is down, there's no activity, and this is going on for many months. Like it's linearly projected out. And the team somehow has no cash balance, even though they just made like $1 million for existing in this past market. Okay, so you take all of those into account, and in that horrible worst case, well then, like it's really not unlike a traditional government where like if everybody's jobless due to COVID, okay, maybe there's some stimulus there, right? Like it's relatively similar to that, but it's not a constant thing. Like it only kicks in because they already have that money. Like what else are they going to do with it? Surely you can argue there's better spending and all this stuff, but like if they already have it, then it stands to reason that it should be used to help the network or the smaller people, let's say. That being said, the ideal scenario, of course, is that there's like, let's say this transitionary period between Solana really becoming like this chain where a lot of activity happens and MEV and RAV are like at some equilibrium or at least steadily increasing, or just like a regular company like Amazon or like an Apple, whatever. Like, and so if there's like a very sharp downturn, okay, then maybe there's a bailout. If there isn't, which should be the median case, by the way, like people are not considering the median case that there's no crazy bear market or there's no crazy bull market. It's just kind of like people launch tokens, trade things and all this, and it just kind of keeps happening. That's, if you look at that scenario and we run the numbers on this, it's totally fine. And so the short answer is yeah, I don't think SFTP reliance is a good thing, but like in a extreme scenario of a bear case, then it's okay, because the whole idea is that this is not necessary as the network gets more activity. And one of the motivations of this proposal, although not directly but indirectly, is that the incentive, and Dan said this, is the incentive is to increase REV on the network, right? And if REV is increasing on the network, then the small validators don't have a concern anyways, right? They're concerned about like, if everything is just goes to shit and the entire world ends, will I also lose money? It's like, of course you will lose money. I will lose money. Everybody will lose money, right? So I would really be, I think it's good to consider edge cases, but like, let's maybe look at the median case as a more realistic scenario.
Keep the markets free, baby. Also, one thing that continually just gets ignored here is SIMD 96 is live, and that doubled validator income, right? Like they get all priority fees, and most aren't sharing with their stakers because it's a pain in the fucking ass to do it. Or like you can use out of protocol things to do it, but like, I don't know, the Jito tip router charges a fee. So like then you're paying Jito for something that should really be in protocol.
So then their argument becomes, and I've done this dance, which is that, well, SIMD 0123 is going to go live, which is in protocol block sharing, in sometime in the future, let's say 6 to 8 months. Okay, once that goes live, then we're scared that somebody will share all their rewards back and then they will outcompete us. And it's like, well, you know, I'm sorry to tell you that's how kind of the world works. They're expecting me to do it. I'm not going to just undercut the market by like $1 billion. Like that's just not going to happen.
I think you should. As a Helios staker, I really think you should.
Like there's a market price here, and so you work within the market. The only reason why we had to do zero commission for issuance in MEV was because the network changed to Stakeway QoS. Like, do you want the developers to just starve and not be able to land any transactions? Like somebody needs to actually take care of that if you want these REV rewards. And so like it wasn't like, oh, I just want to, like, we don't make money from it by definition. Like we literally say we're not going to make money on this when you reduce commission. And so by the way, if you look at like the top 30 other than us, literally nobody has zero commission. So like, you know, it's so that part of the argument I find super shaky, because if that were the case, then how come everybody else in the super, you know, top 30 has like 25% commission on MEV? Like, how does that even work? And so if you're scared of the block rewards being shared too much, one, like just, I don't want to sound dismissive, but like that is, business is competition. Like that is just how it is. There's no way around this. But two, perhaps we can improve the network to get more rewards and actually do this IBRL thing.
Yeah. And I also think in like the long run end state of, not even like zoom out of Solana, like all of the industry, running a validator on a high throughput network, it's like, it's really hard for me to paint a world where it's not a like heavily commoditized activity that professionals dominate, whether that's trading firms, whether that's just validator shops, or whether that's just like businesses building on top of the network, such as Helios and Jupiter and whoever else. It's really, really hard for me to see where like those categories don't just absolutely dominate, because they have the ability to pull different levers. Where if like I just want to, you know, I enjoy Solana, so like I want to run a validator and participate in consensus. It's like hard for me to compete because I don't have another ancillary business around my validator that I can pull different levers with. So I think it's kind of like it's sort of like this at-home staker debate, right? Like Ethereum prioritized those, and this is sort of a move to deprioritize the same group from Solana, and that doesn't. If the goal would be to do it in a way that doesn't negatively impact decentralization. Again, going back to like you need geographical, jurisdictional, and then like data centers and ASN distribution. And if you can achieve those things, I think natural forces will again pull the majority of validators away from the home staking crowd and into the professional crowd because of the competition and competitive forces you described, Mert.
Yeah. Okay. 2 final thoughts on this, and then I'm down forever. Okay. Until tomorrow, or really after the show. Okay. Two points very quick. One is that like, I would also highly encourage people to like stop this stop thinking that like big is evil or something. right? Like people assume that I was just born with the most stake on Solana, just out of my mom's womb or some shit. That's not what happened, right? Like you have to work your way up to it by actually adding value to the network. Same with like Jupiter. Like they didn't just get that value because or stake because they just did nothing, or Drift or Jito and all these guys. Like you need to understand that you don't just get money for existing, or at least in an efficient place, you don't. The current thing, and this is my second point, the number of nodes is not decentralization. The number of active node operators is decentralization, and also how stake is concentrated or distributed amongst them, along with many other degrees. Like, okay, are they in one ASN? Are they in one data center? Are they in this? Does one person have kind of this whole supply? Maybe that's the foundation. Like, how much do they have? It's a very complex equation, but you're really getting a very, very false sense of security and decentralization by looking only at node counts. Like, for example, people think Helios is like the biggest validator on Solana. That's actually not the case, right? So we have like 3.5% of the stake, I think. That's because we simply are transparent about how many validators we have. There are people on this network that have over 10% of stake, okay? And that might be spread across like 8 nodes, and they're unlabeled, and so you won't know. But like, that's kind of my point. That decentralization is not something you want to fake or inflate, because then you have a false sense of security. And when something happens, like that's all it takes. That's what we call a black swan. And so decentralization is much more complex than simply some small nodes, right? Like there's much more to it than that.
Well, fellas, if we're going to credibly call this one a roundup, we need to have other things to round up. So I'm moving us along. Strategic Crypto Reserve. Over the weekend, we got a Truth Social truth from Trump, where he directed the presidential working group headed by our fellow podcaster David Sachs to create a crypto strategic reserve that includes Solana, XRP, and Cardano. Mert rejoiced at that news, and created a little bit of people getting bent out of shape until later he said, of course, Bitcoin and ETH will be the heart of the reserve. Fellas, how do we feel about America buying Sol?
I think it's fucking crazy, to be honest. I don't know. Like, okay. My base case is like, why are we doing this? I think you can make a pretty decent argument around Bitcoin, but the buck stops there. But if I was like really trying to go out on the curve here and be like, all right, let's figure out a way this makes sense. Like, you would probably try to buy every major L1 or L2 asset that you thought had a credible shot at, like, winning the market share of being a global financial activity hub. I don't know if you achieve that with like only Sol, ETH, ADA, or Cardano, and XRP. I would probably cast a wider net if I was actually trying to achieve that. But I don't know. You can clearly see how I'm really scraping the bottom of the barrel to get excited about it. I don't know. It doesn't make any sense to me. We don't own Apple stock. We don't own Nvidia stock. Like, those are America businesses that provide a hell of a lot more value than every blockchain combined today.
Yeah, I would agree. So basically, my thoughts on this are twofold. One is it's a bad idea, or maybe I'll say it's a bad idea to do for anything except Bitcoin. People, you can kind of argue that Bitcoin should be on this reserve if you accept the premise of digital gold and people already have gold reserves. Okay, that's fine. Not sure why Sol is on there, to be completely honest, or Ethereum, but especially, I mean, come on, ADA and XRP. And so then my argument becomes, okay, well, now we have to be realistic and pragmatic. So if it's going to happen regardless, right? Like if the man is going to do it, well, then at least we should get some non-vapor in there. And so that part is like where I'm like, we have to be realistic here. Now, if it were up to me, like if you just asked me, I would say, don't include Sol, provided that you include nothing but Bitcoin. So that'd be something like my argument. But ideally, don't do it in the first place.
Exactly. I think a couple of caveats here. So a strategic reserve is different from a stockpile. So there have been proposals to create a U.S. strategic stockpile where it's like all the Silk Road Bitcoin we seized, we're just never going to sell as the U.S. government. A reserve says we're going to buy these assets off the open market and hold them. I guess the precedent for it is like the U.S. has a strategic petroleum reserve where you can sort of control the oil market a little bit and protect against a lot of downside there. But crypto is not petroleum. And I can't like imagine a world where the US is at a major strategic disadvantage because we don't have enough ADA. So
all right. I'll play this out because this is what I was trying to get at. And I was just we're just so far away from that world. And it will just never be Cardano. But you can imagine a world where like, global financial trade is settled on a blockchain. We'll call that Dan chain. So we're not picking any teams here. And on Dan chain, the gas token is Dan coin. And you would have like the same incentive to own a portion of these financial rails as the rest of the world. It's kind of similar to the Bitcoin argument, except instead of like the preservation of wealth through time, you're saying like, I want to control a portion of this network, right? Like imagine you get an inflation change vote. You want to vote, things of this nature. So like I can kind of see it from that angle. Like let's say global oil trade was settled on Dan chain. You're going to want to own Dan coin if you're like OPEC or the US or the EU, because you will need the ability to trade oil. And so then like I can kind of see it when you go that direction with it, but it does feel like we're extremely far away from that world. And I don't know if that's something I want the US to be like first in doing, in like, buying, like it used to become a venture fund at that point. And like, I don't know if that's really what we should be prioritizing right now, when we're in billions and trillions of dollars of debt.
Yeah, it feels a bit like the thinking was, oh no, the cryptos are way down. Everyone's pissed about Melania. Donald tells David, hey, why don't we promise to buy like 3 of the 10 biggest assets that have some roots in the US? And then he agrees to do it, and it made the numbers go up for a couple days, but
a couple hours. Right? Basically, everything's already retraced, but that 20% pump did feel nice. Good to know we still got it on a Sunday night too. No liquidity in the books. Just let these things rip.
Yeah.
I don't know. And then like you saw a bunch of like, I don't know, people posturing like, oh, we're an America coin. Like I was like, all right, like now I just feel gross.
Yeah. So that's that. I guess Mert we'll let you chat a little bit about Base and their Flashblocks, which you were getting back into vintage circa 2023 Mert mode when that came out. But what's the deal with Flashblocks, and why are you unhappy with the way it's been marketed, shall we say?
So actually, Flashblocks was announced a while ago, and when it came out, because it's by Flashbots, when it came out, I said this is pretty cool and commended them for it, and that was months ago. But so what has now happened is Jesse is now saying Base will be faster than Solana, 2x faster than Solana. Just obviously, clearly baiting for engagement. Obviously, clearly does not care about the reality of the situation there. But the good news is that I actually know how it works. Because it's from Solana. And so the way it works is on Solana, everybody knows that a blockchain is composed of blocks. What they might not know is that on Solana, that's a bit more complex, right? You don't just build blocks as like one big chunk and then one big chunk and then one big chunk. You continually stream them, right? You continually stream these things called shreds until the big block is built. And like, for example, a shred might take, like a batch might take like 15, 20 milliseconds, right? Even though Solana's current block time is 400 milliseconds, right? And so there is the block time, and then there is kind of like the perceived block time where, for example, if the other thing that happens is if you send a transaction to it and it commits it to proof of hash or proof of history, then it treats it as it executed, and so you have that data, and so it's actually pretty much like an L2 sequencer, right? Okay, so that's Solana has this concept called shreds, which is continually streaming the blocks, the shreds until they become a block, right? So very important. Shred, small piece of a block is just everybody knows what a block is. Okay, so then what Flashblocks does is, okay, I don't want to say Flashblocks does this. I will say Base does this, which is, so the concept of shreds, you take them, you put them on Base, but then you rename them to blocks. And then you say, this is faster than Solana. So you have taken the exact same concept on Solana, added to your own thing, but then renamed it fallaciously to make it sound like it's faster than the other thing, which was not the same concept, which you know because you took it from the other concept. Okay? And so that is just pure marketing. I mean, it is pure fucking dishonest. I don't even, and I tweeted this. I said, I'm not sure I've seen anything this deceptive in crypto before, because it's so sneaky, because nobody's going to care, right? Nobody's going to actually look into this. Barely anybody even, I mean, one of the lead devs of Abstract, he commented, he's like, this is insightful, I didn't know this. Like, even if he doesn't know, retail does not stand a chance. And then, okay, let's just take that away from this. You're also comparing L2 block times to L1 block times. Okay, now that's like me comparing a helicopter's vertical takeoff speed to a jet fighter's horizontal, like supersonic speed, and saying the helicopter is faster. It's like you're measuring something completely different, with different guarantees, different properties, right? Just not the same thing. This is not the same thing in any way. And by the way, you can do the same thing on Solana. And in fact, we serve shreds to our customers who want it, like quants. And so then there's one difference, which is that Flash Blocks, I believe, sets some sort of an auction such that the rollback guarantee is stronger for Flash bots, so on Base. Whereas on Solana, it doesn't really exist because nobody's actually done it. And so I said, okay, well, just out of spite, I might just add Helios, right? It's really not hard. I mean, it might be hard, but you can easily get like a 4 nines SLA on rollback guarantees on this. And so TLDR, take the concept of shreds on Solana, even though they're not blocks, say they're blocks on Base, and then say they're faster now than Solana blocks. Not cool.
Yeah, I was hoping you were gonna leave the last part out so I could come in and play team Base here, but you're right. Like the big difference here is you're running a per. We'll call them shreds for the sake of this conversation. You're running like a per shred auction or a per flash block auction, right? Where on Solana shreds, you can trade against that changed state because you can see it, but you're not necessarily running like on Base. It's a priority ordered auction, right? So everybody's within this single flash block. The priority fees they pay determines where they're ranked in the transaction execution table. And that's the big difference, where like I tweeted out like a thing that was my imperfect but close enough analogy here between the two is like Solana shreds, but you enshrine an auction. So it's like enshrined Jito-ish. It's not perfect, but it's close enough, because that's the difference. Again, you're running this auction, which Jito auction runs, I believe it's 200 milliseconds today. So that's just basically, but only a portion of transaction throughput moves through the Jito auction rather than like the traditional rails. And that's a huge difference between Solana and Base. So they are just like taking that idea and like implementing it at the in protocol level. So like that to me is pretty interesting. I kind of agree with you on the marketing stuff, with the one caveat being it's hard to explain something this complex to retail. Like if you were to call it shreds and like mini blocks or whatever, maybe it would hit. But like the point is that you can transact faster on Base and the UX will be cleaner. But like how you convey that message, I thought it was a little bit Solana comparative. Like you don't really need to talk about Solana. You could have just said we had 200 millisecond block times, but like that's the nature of the game a little bit as well, right? Like,
yeah, I mean, I have a great solution for this, which is a new SIMD that I'll be putting forth, renaming blocks to shreds, or no, shreds to blocks. And so
SIMD
Solana will have 20 MS. Absolutely. And I saw the tweet that you posted, and I think, it's not a bad way to think about it. That being said, I think, was it Bert who actually?
Yeah, so there's gonna be like a different auction mechanism, which I don't. And I was like, oh, sick. Like, what can I read? And I didn't get a reply, unfortunately. But I think they haven't published what that's gonna look like. But kind of curious if it's going to be like any different than priority ordering. I don't know if you need that. I would be shocked if they're going to introduce bundles, especially on base. I feel like that's a huge advantage. Is the fact that you can't get front run is like programmatically impossible unless you distrust the Coinbase sequencer, which I see no reason to do so. I can't. So I'm just curious what that auction is going to look like.
And just because maybe I got a little heated, so people might think I'm biased, but the fact that there's shreds is not something I'm making up, by the way. If you just read the announcements of Flashblocks, it's something they themselves say. So like that makes it. And by the way, I wanted to be very clear that it's not a knock on Flashbots. I think the Flashbots guys have designed a good system. I think like that's open source. That's what it's about. You take the best learnings from other systems and whatnot. The problem is not even optimism. The problem is a certain person on base making up marketing terms and not discussing anything else other than a one-liner that's meant purely to deceive.
Well, now that we've covered all of our bases, I think we'll end it here. Thank you, everyone, for tuning in. Please take a second to subscribe to the show, give it a like, all that good stuff. Subscribe to the daily Lightspeed newsletter written by yours truly for daily Solana news and analysis. And grab your DAS tickets. It's coming up this month. Use the code Lightspeed10 for 10% off at checkout. Thanks, everyone. We'll see you in the next one.